What's up, everybody? It's Monday, August 29th. You know, there's a saying, I'm sure all of you have heard this saying. The saying is that money can't buy happiness. And that's probably true, but money does solve a lot of problems and it does make life, easier. Unfortunately, that's just the reality. I mean, if you have bills to pay, if you have medical expenses, if you want to, get an education or send your kids to get an education, or if you want to travel, or, you want to pay your taxes. I mean, it just alleviates a lot of headaches. And it's no different with the economy and the financial markets. And that's why I keep telling you that as long as we are in a condition such as we are now, where financial balances of the economy are growing. How does that happen? It happens by net spending by the government, by deficit spending. Spending more than the government is taking away from us in taxes. And that is happening right now. The deficit for August is $230 billion. That is the biggest deficit since November of 2021. And I caution you, as enticing as it might be to want to go short the market or liquidate your stocks because, you're fearful of rate increases and monetary policy and Powell coming out with all these hawkish comments and stuff like that, I really caution you not to do that. If we were in a situation where those financial balances were being drained down and, where the drain was ongoing, let's say where the government was purposely now engaged in policy to run a surplus, then I would say yes, get out, put your money in cash, and it's not time to be in the market. And you should have a negative or a cautious outlook for the economy. But that is not the case. Now, having said that, I will tell you that I think right now, the reaction that we have seen in the last, week or two in the market with this big drop that was a result of once again, these interest rate fears just blowing up, and Friday's ridiculous 1,000-point sell-off because of Powell's 8-minute speech. And by the way, I mentioned this in my video on Friday, that there was no movement in Fed Fund futures. I mean, basically, they're still pricing in the same rate hikes going out to next year. I mean, 75 basis point in September, 50 basis point in November, 25 in December, 25 in January, and no change in February. So it's definitely, at least as far as the market is, the expectation in the market, which Powell has shown himself to be a follower of that. I mean, it is clearly a situation of paring back or scaling back those rate hikes. But me personally, I don't care about the rate hikes, at least not in the same way that these monetarist zombies do, because I understand that rate hikes, that is a fiscal expansion because, it goes through that interest channel and it adds to payments in the economy. So that's another example of how financial balances are increasing. Let me put it this way. If you personally were seeing your financial balances month after month go up, okay, if your bank account was getting bigger and bigger every month, would you be bearish on yourself? Would you be negative on your personal situation? I mean, if you had a neighbor whose financial balances kept going up, I don't know, he kept getting salary increases every month, would you short that guy? I mean, it's just, it's crazy. I mean, but this is, and the other thing to consider is that these increases in financial balances and, you know, 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 I mean, they go to offset some of the other problems, if you want to call it that, that come along with rate hikes. For example, higher cost. If the higher costs are met with more funds, then there's not a problem. Now, I know what you're going to say. Hey, me, I'm not getting any increases. Yeah, I understand that. It's not all divvied up equally. It's in the aggregate. That's why I always use the swimming pool analogy, because, you could put water in at one end of the pool, and then, it circulates around, and eventually the whole level goes up. Now, you might not feel that that's true, but in fact it is, because if the economy grows faster, then ostensibly, at least, there's more opportunity for everyone. The pie gets larger, and maybe your slice of the pie proportionally stays the same. Maybe even it goes down proportionately, but the absolute value, the nominal amount, gets bigger. Okay, we want the economy to grow. If it grows at 7, 8, 9, 10%, then we're all going to be doing a lot better. Businesses are going to be doing better. Salaries and wages are going to go up, that sort of thing. So I don't look at the rate hikes as a negative. And I know that 99.9%, I'll even say 100% of market participants, of investors, of the financial world look at it that way. Now I try to train you guys to see it from a different perspective. But the most important thing that I want to say is financial balances of the economy are increasing. Now, I'm going to say something else, because I've been telling you guys about September 15th is a quarterly corporate tax payment, and I've been talking about this since like June, July. It's going to be a net drain. I happen to think that right now, where the market is, like, we have declined so much in the last couple of weeks off of the top. Like, we were almost at 4,400 in the S&P. We're at 4,000 now. We've had a 10% decline off of that high. I think, frankly, this decline already reflects the corporate tax payment that we're going to get on the 15th, or that is going to be paid on the 15th of September. And the reason I say that is because we're going to end this month, we're at 230 billion deficit. We still have what, Monday, Tuesday, Wednesday, 3 more statement days left. So we could come in around 260 billion deficit for the month of August, okay? And if you subtract off of that, because about 120 billion is going to be drained temporarily, I might add, but let's just, go with the 120 billion drain that's going to happen on the 15th of September. That puts us at a deficit, if we subtract that 120 billion off of the 260 billion deficit for this month, it puts us like about 140 billion deficit. I mean, that's kind of like where we were in around the first week of August, when the S&P was trading at 4,100. So the way I figure it, anything below 4,100, which is where we are right now, that's just like the rubber band got stretched way too far now on the downside. And if these, zombies want to take it down further, like, I'm a buyer. I am a buyer because, like I said, I think the current situation right now, fiscally, and that's all that matters, because that is the thing that either fills up the swimming pool or drains it out. Okay? Interest rates are just, they're either another form of fiscal expansion, or they could be a form of fiscal drag if rates are cut. But so I really do not put a lot of emphasis on that whatsoever. I understand what it means, and I use that understanding to, just create the full picture, to understand the full picture. But it's all about these financial balances. And again, you have to think about it in your own term, in your own personal terms. Like if your financial balances are going up, you're not going to be stressed out. You might be stressed out about other things. Maybe you got health problems. I don't know. But I mean, in terms of your finances, you're going to be sleeping okay at night. And that's exactly what is happening now. Okay? Now, granted, the financial balances are not increasing like they were last year and the year before during the pandemic. But they're nowhere near what we saw in April when the deficit for the year dropped down to like $500 billion. At least now it's like 1.2 trillion. We've added 500 billion, half a trillion since the end of April. Really, since I guess you could say since the end of June. And, that's what's been lifting everything up. Now, this recent sell-off is just, this is zombie. Folks, listen to me. Listen to me. This is zombie craziness. This is zombie mental illness. This is zombie psychosis, okay? Because they only think in terms of monetarism, and it's ingrained in them. It's literally branded into their brains that rate hikes are negative. They don't see the full picture. I mean, I've been repeating this message over and over and over again. I don't know how many times. I'm going to switch topics starting tomorrow. But all I want to say is right now, anything under 4,100 on the S&P, and you're going to see, I'm going to be, it'll end up that I'm going to be right. We're going to come back and talk about this in November. How this was just another opportunity to buy anything under 4,100. Now, above 4,100, I'd say right now, we're not going to move that much higher above 4,100. But yeah, because there is going to be that drain, and I think this is what fair value is for now. But and I'll give you an exact date, by October 6th, write it down. Everything will start, we'll move up, we're going to trend towards new highs. So from right now until October 6th, it's choppy land. But anything under 4,100, that is an undervaluation. That is selling on the part of monetarist zombies. It's a psychosis. It's a mental illness. Take advantage. I'm here. I'm trying to help you guys. I'm trying to help you. So that's it for today. The new edition is out of MMT Trader. Go to my website right now, pitbulleconomics.com, and sign up for a 30-day free trial. Bye.